Hi guys, can everyone hear me? Okay, perfect. So just be patient. We're just connecting with Shankar Sharma. He's going to be with us just any second now. Do keep sending your questions. I know on Instagram, Facebook, Twitter, all of you have been sending questions. But just hit the Q&A button on your screens and send the questions that you would want with Shankar Sharma. I know a lot of you have been sending greetings, saying hi to Shankar Sharma, hi to Team BTNA. So hello all of you. We're just waiting for Shankar to get connected. Just bear with us. Technology, all of us are working from home. Gets a little tough to, connect cross city, and we will start just very, very shortly. But do send us questions. Shankar has been talking about a bear market rally for a while now, and what a rally it has been, boy. So I'm going to be taking a lot of your questions, in fact all of your questions. So just hit the Q&A button, send us all your questions. I can already see your names, so you don't have to introduce yourself. I know who you already are. Yes, Sajid Habia, good afternoon to you as well. To all of you all who've been writing in constantly, waiting patiently. We already have about 250 attendees here. We're just waiting for Shankar to log in, and we're going to be starting very, very soon. I will take all your questions, Satish, on unemployment scenario, what the past experience has been. A lot of market questions as well have been coming in. Don't worry, we're going to be taking all of your questions. I'm not going to let Shankar hook off. He's been a little late, so he better make up for the lost time as well. And we're going to be taking all your questions. Don't worry about that. If you could just skip the greetings, it's good afternoon to all of you and hi to all, but just restrict your chats to the questions that you want answered, because there's just so many highs and hellos here. I'm going to lose all your questions otherwise. So yes, we already have 17 questions. Great. Keep hitting the Q&A button and keep sending us all your questions. I hope my audio is loud and clear. A lot of you say yes, it is, and I hope you're not getting the echo anymore. I can already see Shankar online, and we should start just any second. Wow, there are a lot of questions for Shankar here. Yes, we will try and have Purin Juveliat as well, Kaushal, soon, very soon on a webinar. So I'm just going through all of your questions here. And there, I can see Shankar already. Should be, yeah, there he is.
So I got the wrong link.
Oops,
Now
okay.
This is the correct one. Hear me?
Yep, I can hear you. Can you do an audio test once more, Shankar?
Yes, testing 1, 2, 3.
Perfect, perfect. Shall we start? Admin?
Yes. So all good? Are we good?
I'm just going to wait for a green signal from the admin. Let me just
problem.
check the various devices. Can we start? Yes. Okay, yes, we're good to go. There goes. Boy, Shankar, what a rally it has been. I know you've been talking about a bear market rally, but itna zyada, I mean 11% in April itself, about 30% from the March lows. What's happening?
Well, I think we've spoken about it, and we have had a vertical fall in the month of March. And by the way, India is the only country, only market which has rallied. The entire world has rallied. India has participated along with it. And in March, India had fallen more than the rest of the world, along with Brazil. So obviously the rally will be a little bit more powerful than what we saw elsewhere. But it's not an isolated rally only in India. It is happening everywhere across the world. The NASDAQ, by the way, is now up for the year. Just so people know that. Yeah.
Yeah, absolutely. But Shankar, I mean, markets have the tendency to overshoot on the upside and overshoot on the downside. Do you think that played out for not just India, like you're saying, but for world markets? I mean, I wonder what is the exuberance about? We're still very much in the midst of the pandemic. The vaccine is still about a year and a half, God knows how long away.
So don't start trying to make logical sense out of markets all the time. In fact, my experience tells me illogical most of the time. So, I don't get too, fussed about, what is the market thinking? Why is it going up? Why has it fallen? That's the market there. It's a playful little child. So sometimes it will do all kinds of silly things. So it did not merit, financial going up so much prior to, this fall. And now they are being just crushed as if they are going to go out of business tomorrow. So on both sides, you will see, overreach. Fact of the matter is the real economy in India is hurting. Nobody can, argue against that. Stock market is not the real economy in its entirety. It is a part of the economy, particularly the larger, well-capitalized companies which will survive this very, very brutal month of March and, still ongoing in the month of April and May. So let's not start, getting romantic about this rally. It was going to happen because of the, terrible fall of March. It has happened, but I don't think the real economy is anywhere close to reflecting what the stock market is reflecting. If that is what your question is, I think the real economy is still a long way away from achieving any kind of normalcy.
I'm going to come to the real economy in just a bit, but since you talked about romance as well as the little child in the same breath, what is the little child going to do next? Jump around, getting up on the slide, come as swiftly down as well? Is it an L-shaped recovery, V-shaped recovery, U-shaped recovery? And should we even put our minds to it as to what's going to happen next, or just play it by the day?
I just don't think, I just hope the little child doesn't do what children do, which
Cartwheels.
Parents have to clean up afterwards. So, because that's what it did in March, and I hope it doesn't get repeated in May. So the point is, I think this little child has kind of more or less, done what it was expected to do. From here on, I think the real economy will come back into force. I think the market is also expecting some kind of a stimulus from the government, which has been long awaited. I think it will come, but I don't think it will come to the extent that the markets want. So all things put together, I think markets will probably, run up a little bit, but not a lot from here. And therefore, like I said, I think earlier, on one of the other programs, we have played this rally. We are up 16, 17% in the month of April. But we are not believers in it. We have played it. We are not beginning to believe that that's a real movie. That's like reflecting real life. It's not.
Yeah, absolutely. But a lot of ponderables here, Shankar. We're amidst the national lockdown. Sunday is when it's supposed to be lifted. We haven't heard from the government on that. Markets have been waiting on the stimulus. We haven't heard from the government on that as well. Do you think these are going to be key catalysts? I mean, irrespective of that move to 9,800 just yesterday, this morning SGX is down 4%. It's already down 500 points from the top.
Oh, I have not seen the SGX. SGX is down today?
It is 500 points.
Yeah, because I think I just briefly glanced at the Japanese market. I think the Japanese markets were down to 2.5%.
Yeah.
If I'm not.
Yeah. Yes.
I think the markets, after having run up quite a bit, are now beginning to wake up that the situation, at least not just in India but elsewhere, is also not perfect. Although bear in mind, I was just reading some report this morning that at least some countries now, you got a zero infection, new infection the last 3-4 days time. I think South Korea and Hong Kong. So at least some green shoots of hope are beginning to emerge. But markets already reflect that to some extent. Hence, you will see a little bit of a sell off from these kind of elevated levels. So if you're telling me SGX 50 is down 500 points, so there you are. It is beginning to happen to some extent anyway.
Yeah. And the correlation with the world also, Shankar, and I'm just looking at the graphic right now on the screens, the 2020 performance so far, we're still down 19%. So, in the sense where we may feel very happy ki, 30% recovery ho gayi hai from the March lows. But the fact of the matter is you're still sitting on a negative return year to date.
Not only that, Ayesha, last year, which was a blowout year for global markets, they were up like between 25% to 50%. Okay, India didn't do anything. India was, I think Nifty was up some 8-9%, and the small caps were probably, I think, flat or maybe up 2-3%. So we have not only missed out a huge blowout rally in 2019, but even in 2020, we are amongst the worst performing markets. And it's very interesting to see the bottom tier of markets. basically India, Brazil, Indonesia, South Africa, Mexico, all countries which are running very high deficits. So markets are saying that the good countries will be the countries like South Korea or even Malaysia or for US, Switzerland, all of them are running, at least have surpluses to deal with it. Markets like the bottom markets are not in a very, very strong position to deal with this. The markets are giving you a very, remember, 2008 was a uniform 60% down for every market in the world. This year, markets are nuancing. They are separating the strong from the weak. And this year's performance till date exactly reflects that. The stronger countries are doing very well. The US is almost as if there is no bear market at all. I mean, the Nasdaq is up for the year now. Switzerland has done very well. China has been doing very well. While at the bottom you have all these markets like India and Brazil and Mexico, etc., which are struggling. And the other thing is markets are telling you only one more thing, which is the scale of financing required for India to come out of it. Frankly, is out of bounds for India. I mean, that is the reality everybody needs to understand. Just to say stimulus, all that is fine, but stimulus wo aayega kahan se, right? I mean, you have GST, which will be down, I don't know, 20, 30%, 50%, all numbers all over the place. Government itself needs money. Forget about giving you some money. So none of this is, we can keep sitting and hoping. The hope trade is always there. But we have to be realistic in this game of investing. And that only tells me that India will do some stimulus, but it won't be like a big bang, US style, or, whatever, China style. अपने बस का नहीं है बॉस, मान लो ना इस बात को.
But problem kya hai, Shankar? Just exactly that you were saying that 2019, we failed to participate in the rally along with the rest of the world. We know that there was that economic slowdown. There was that lag of GST, demonetization, what have you, and various sectors felt the pain and continue to do that. And now comes this double whammy. But what is it? Is it a structural issue which has pegged us back? Or is it just these reforms which were put in place, which were, you could debate about whether they were callously put in place, whether they were not thought through, or whatever it may be.
So it's a culmination of several of the moves you mentioned. Okay? We started in 2016. The demonetization, we all know anecdotally and otherwise, it had some effect on, real businesses, people, economy, etc. But the economic numbers never reflected that. Okay. The key question is, why did it not reflect? Because growth seemed quite okay in 2017. Okay. The reason was it basically was because of the NBFC stepping in to fill up the void of capital. And they went in like, guys going into the valley of death, literally, with all guns blazing. And they went and financed all kinds of businesses that were hurting till the ILFS problem happened in 2018, and then that whole party ended. Since then, if you see auto sales, consumer, etc., everything fell off a cliff from August, September 2018. So basically from demonetization till today, you had NBFCs that came in to fund the sort of gap that PSU banks weren't willing to do. And they have gotten hurt badly, in fact, almost on a terminal basis. But there is no capital available to re-stimulate the economy. And, to bring you back from where you are, you need money. As simple as that. But you have fired all your bullets. Now, all the bonanzas that existed, oil bonanza, this bonanza, I don't know where all of those have gone, but clearly they are not available to the government to resolve these problems. And GST, which was supposed to be 1,25,000, 1,20,000 crores, was running at 90,000 crores, already a big deviation. Now with this, you're going to have a 20, 30, 40,000 crore cut even to that. So your revenue estimates are completely, haywire. You don't have capital to fund your own exchequer, let alone fund people who are hurting. So the problems are a culmination of a series of events that have happened from 2003. And one more thing, this has happened at the worst possible time for India. Okay, so 2008 crisis. Go back to India in 2000. That was the kind of numbers India was delivering just when it entered 2008. Therefore, 2008 didn't even matter. It just came and it went. You ask anybody, do you even remember it being so painful? As an individual, for the stock market is another question. But real economy, it was not. It just came, it put down for a couple of quarters and then took off like a rocket. And by 2009-10, we were growing 9.5%. So, or I think 8.5%. And that's the old GDP numbers. So because you were in a good fiscal shape, you were growing well. Corporate India, by the way, was very, very strong. You rode out that big crisis. This time, getting into this, you're already a sick man. Corporate India was sickly. The macroeconomics of India was sickly. And then you get a disease like this, you have a serious problem. I mean, this is not rocket science to figure it out. So what I'm saying is it's just going to be a little bit of a model for India to get out of this problem. And I hope we do. We've been hurting a lot. I mean, look at the urban poor, for example. Whatever you hear is heart-wrenching. There's no, people don't have even basics right now in the lockdown. I hope things happen for the better. But as investors, we need to be very careful, very vigilant, that it may not be as smooth as many people expect it to be.
Though, just one point, Shankar, it's unfair to compare what's happening now with 2008. I mean, 2008 was a financial crisis. This is a scientific/medical crisis.
It's still a crisis, right? And every crisis needs ultimately money to come out of it. So, crisis can differ, right? In terms of what caused it. But the reality is when you have a crisis, how are you equipped to deal with that crisis? It's very simple. That's ultimately in this environment, India needs to pump a lot of money to save the economy, right? Does it have the money? No. In 2008, did it have the money? A lot more than what it has today. It's as simple as that. So yeah, it's a health and a medical problem. That was a pure financial problem, but it still caused widespread damage, which you had the bullets to fire then. You don't have the bullets to fire now.
Yeah, okay. I needed a sip of water to try and digest all that you're saying. Okay, I have 66 questions. I better start taking them. Rest our panelists are going to get a little impatient. Okay, starting off with Jay Udeshi. He's saying, as we know, markets usually run ahead of the economy. We've seen a 30% run up in the markets from the lows. Is there something that we're missing here?
Well, they have run up everywhere. Again, I'm repeating. So India is not isolated in this run up. Markets have run up everywhere. Obviously, from where the GDP numbers will come in for the March quarter and the next quarter, India will be a little better off 2 quarters down the road for sure. So we can't call it a recovery in the real sense that you go from a 0% GDP growth situation to a plus 2%. Markets being markets, like they fell a lot. Now they've rallied a lot. We will see how it goes. We are playing the rally for whatever it is worth. But we'll look for real evidence to start forming a hard view that now worst is behind us. Okay. So like I said, you can play the market without being a believer in the markets. At least that's where we stand right now.
Okay, Nandita Khemka wants to know, have you changed your outlook after this week's run-up in the markets? Any aggressive target for the Nifty, or would you still call it a bear market rally?
We don't care. We are fully invested. So we have made 16, 17% in the month of April. So we are liking it. I mean, so, the answer to your question is, do we believe in it? No. Have we played it? Yes. What is the target of the Nifty? I have no idea.
Acha, nicely escaped that one. Adi's asking if the current rally is a bear market rally or a new bull market has started. Bear markets generally last for 13, 14 months. Is this different or is it the same? He has many questions about India's GDP, etc., which I'll take in a bit. But first on his question on whether and how long this is going to last. Pretty much along similar lines as Nandita.
So I don't think it is a resumption of any bull market. By the way, India has been in a bear market for about 2 years at least. It's only the Nifty which was catapulted by a handful of stocks. And we all know that 8, 9, 10 stocks are financial, some consumer, which were propping the mainline indexes up. But small caps have been down 25, 35% last couple of years. So India has been in a stealth bear market anyway for the last 24 months from the time the small cap collapse happened. Within that, you had small patchy bull market, like I mentioned the 9-10 stocks. I don't think you're going to get a broad bull market anytime soon. You will get very segmented, sectoral bull market. Like pharma, big bull market is currently on. All right. Again, I'm not recommending people listen to them go and buy pharma. This is not a forum to recommend stocks or strategy. This is only to discuss what is happening. So you will get patchy bull markets, not a broad overall bull market. That is my simple analysis.
Fair point. Adi has another very interesting question. He's saying, is this the right time to open up India's economy and allow huge FDI investments as we made the rupee convertible back in 91? Is this the right opportune time then to attract foreign investors with a golden carpet welcome?
Well, I think any time is a good time, but today, if I were, let's say, the CEO of India, I'd be out on the road 365 days a year, wooing companies from across the world, not just US, but from Japan, from Europe, even from Taiwan, etc., that come to India. We are open for business. We are far better equipped than Bangladesh is or Vietnam is, because while they are good, but they don't have the absorption capacity for large scale projects, because still they are small countries, small labor forces. We have huge land. We have huge excess labor right now. We have a 30% unemployment rate. I would be out there advertising. I would be blanketing networks in America, on CNBC in America, on ET Now, partners in America, on Wall Street Journal in America, Patterns in America, putting out full page ads. I'd spend $500 million on advertising, because ultimately it's a marketing game. I would be a great marketeer if you put me out there. I would go and sell the India story like crazy. Okay, but I'm not a CEO. That's okay. You're asking me my question, and the answer is this: it's a great opportunity for India to be aggressive, and it has to be done by the mainline leadership. It cannot be left to some bureaucrat going on in America. You have to get on the manufacturing capacity. So I agree, it's a great time right now. Hit the road, blanket the networks, do mass scale advertising, one-to-one meetings, town halls with people across the world for 1 year. You will get huge capacities in it. What is the big deal in that?
Yeah, and if there's anyone, Modi can totally do that. Chetan Gill is asking that the recent credit risk crisis in Franklin Templeton, though more of a liquidity issue rather than a credit issue, shows that in post-COVID environment, lower-rated corporates will have problems in raising debt and could face problems or possible repayment issues, and therefore an impact on the share prices of these lower-rated companies up to AA rating. And that's exactly what we've seen play out, Shankar, when you had that failed TLTRO 2.0 as well. It's the same thing that we were faced when IL&FS happens. Liquidity hai, but no one wants to lend.
Yeah, so banks are happy to borrow at 7% and lend to the government at 4% at least. I mean, it's just a weird situation. I remember a lot of this happened in the 90s also, when banks, again, the sort of post-crisis situation in the 97, 98, 99 era, banks were happy to just lend to, the government through excess SLR securities, because, they didn't want to lend to industrial India. I think it's pretty much a repeat of that. The reality is that if AA paper becomes illiquid, which is what is the most surprising thing here in this whole Franklin Templeton issue, it's not as if they were buying only junk. I don't know what they bought, but I think, if AA and below, slightly below is illiquid, that tells you the scale of the aversion, number one. Number two, it tells you that the rating agencies are all rubbish. I don't know what ratings they're putting out. That AA paper is or single A paper is illiquid. So I think there's a serious problem on that front. Nobody wants to do lending, and if I'm a lender, I would not want to do any lending at all.
So as an equity market investor, Shankar, what is the scenario that you're looking at? Because, like Monish Vijayan has asked, Indians don't have a very many varied choice of asset allocation, debt, equity, REITs, they all correct at the same time. You have gold, you have real estate. We all know what's happened to those asset classes. And then even your mutual fund NAVs are not safe. You've already eroded last 3 to 4 years of your wealth there.
Look overseas. Very simple. There's money to be made globally. India is not the only game in town. This year in China, one has made tons of money. this, many stocks we have made, I think fair margins are 30%. But of course, there are many places in this world to make money. And if you're not going to go out, you will end up suffering the problems that every investor in India suffers from, which is exactly what the gentleman said, that, pretty much everything is correlated, everything falls at the same time or rallies at the same time. So there's really no diversification option that you have here. So the only thing I can say is look overseas for sure. But choose wisely. The very dangerous thing. Indians have trouble understanding India. The world is a very, very wide market. Choose your advisor. Again, it's not a recommendation. Choose your advisors very wisely. It's a very, very dangerous place. You can be wiped out as quickly as, it can be wiped out in a mutual fund in India.
Sure. Everyone's needs, requirements, goals, capital allocation, it's all different. All these 308 participants here and all those people who sent our Q&A, everyone's dynamics is very different. But at large, if you have to asset allocate for the next 1 year and then for the next 3 years, say suppose, what is it that you would recommend, Shankar?
So, we don't believe in taking 3-year views because, that locks you into, and I don't think markets anyway take 3-year views. My view has always been markets are 12 months maximum. It doesn't go beyond that. So, my view is very simple. 30 and 50% equities, at least 25% gold and at least 25%.
Shankar, Shankar, could you repeat that? We lost your link there, and I think this is an answer everyone would want to hear.
So between 40 to 50% equities, and the balance 50% you can split between gold and government securities, not the sort of the corporate bond market. Again, not a recommendation. This is a pie chart we think is sensible right now, but our views might change next month. Again, with that caveat, we think right now, as it appears, this is. Are you getting me, Ayesha?
I lost you there, but I largely got the pie chart. But tell me, what about cash levels, Shankar? Because for the next foreseeable future, you have to keep some powder dry with you.
If you have any cash.
Very important question. Yeah, but nonetheless, if you do, a big if.
So as any prudent investor, will say we'll keep 5-10% cash. But we can quibble about that. My view is that it's a the cash call you can take based only on market action. If markets start to sell off, then let the market take your positions out as a stop loss, sit on that cash. Right now, you can allocate the 50, 25, 25 broadly speaking.
Shankar, what happened in February, and I recall that I was in Dubai when I was getting these frantic WhatsApps on my show chat, etc., saying markets have crashed so much, blah, blah, blah. Up until then, you thought that the problem is very China specific. You didn't foresee that this is going to be a global pandemic of sorts. You thought, okay, chalo, markets are nervous, this 500 point will absorb it all. Now, of course, this has become a reality of a daily day. What if the markets fell that swiftly that you did not have an option to conserve your cash at that time and book out? Then what do you do?
So, what we saw in February and March were extraordinary markets, without any doubt. And, I've lived through a lot of markets. A 25-30% down market in 1 month, I can't even remember, when that happened. Yeah. It absolutely just fell off a cliff. But there was adequate, indication of at least a reasonable fall coming into from February 20th, February 15th to 25th. We could see signs building up. Even that were coming to Italy and then going to parts of Europe and some US things that started. So you knew it was no longer just a Wuhan or even a China problem. At that point, when markets come a very, all they need a little of bad news for them to tank, right? So globally, markets are done phenomenally well, and then this thing happened. We at least got very clear that look, this is % down market, so let's get out. So that's what we did. So I didn't foresee 30%. I saw 20%.
We completely lost you there, Shankar.
Gosh,
Okay, now.
really?
Now we can. Now we can. So, okay, I mean,
Wait,
you know, you're a
let me
seasoned
try
market
and write it.
veteran. So you saw the signs, you got out, but many retail participants could not. What do they do now? What options do they have? Is our link with Shankar frozen? No, he's
Yeah,
back. Yeah.
I'm back.
No, yeah, you're back. I was just talking about the poor retail participant there because, you know, Shankar, they're not in the thick of things to catch the pulse of how far and wide this is going to spread or try and understand that, boss, this is a sign, nikal lo.
Right.
Not everyone could do that. And it happens so quick. You're like, what's happening here? What do those people do? Because they've had the last 5, 6, 7 years of wealth eroded. I mean, what's the option for them when it comes to equities?
Yeah, I mean, I'm glad you bring this up, Ayesha, because we get a lot of emails every day. I mean, literally hundreds. And the usual question we get is, take a look at our mutual fund portfolios and tell us what we should do. And when we look at the returns,
Yeah.
1 year returns negative, 2 year return negative, 3 year return negative, 5 year return maybe 4%, maybe 5%, which is not even beating your FD rates. I mean, it is a wasteland, and I feel for people because we've been told that we should make at least 12%, maybe 14% in equities to be there.
Yeah.
We're not delivering that. The whole industry is not delivering that. The market is not delivering that. So that is exactly what the whole meaning of asset allocation is. Gold has given you in this year, I think, 18%.
Yeah.
I think, not mistaken, something like that, right?
Yeah.
This year, 25%. I mean, equities don't even show up on the radar of returns. Government securities, Ayesha, this year I've given you, I think, about 7-8%. Last year they gave you about 15%. This is government securities safest credit in India. I did not have to go and buy a credit risk fund. All I had to do is to buy government paper and I would have made 10-15%. Gold made 25%, equity made 0 or negative. That's the meaning, that you please don't get exposed into only equity, because that's where we get paid the most. We have biases. All of us are biased towards equities because equities make us the most money in terms of our own commissions. The reality is that they are not always the best place to be in, which is why that allocation pie chart is extremely important.
Sure. So if I were to follow that pie chart, what is the realistic assumption for returns for the next 1 year? You said 40 to 50% allocation equities. What is it that I can expect in terms of a return? I think those levels of 15% returns are long gone.
Oh yeah, they're long gone for sure.
Yeah.
I think we can agree on that. So,
Yeah.
so I think your best case is, first of all, capital preservation. So this allocation pie chart will make sure that you don't get wiped out. Okay. Because remember, people call me bear and all that, and I just laugh. I say I've been around 30 years and I've made money through good markets and bad markets because I'm a cautious person by nature. And if being cautious is being bearish, I'm happy with that. Because there is risk. The way the marketing of mutual funds happens, as if there is no risk. ये सब ठीक है, सब ठीक हो जाएगा, वी शेप हो जाएगा, 30,000 पे बाई है, 50,000 पे बाई है, 40 पे बाई है, कभी बात ही नहीं करना है कि बहुत थोड़ा रिस्क है, थोड़ा पैसा साइड कर लो. Nonsense. The kind of mis-selling that happens is irresponsible. And when I come and tell you that, look, markets look dangerous right now, be careful. Yeah, you'll say, I know I'm a bear. Hey, guess what? I'm making money. You are not. That's the point. That be cautious in this game of investing. First and foremost, don't lose money. That's the law number one. Imagine if you lost 35% or 30% in March, Ayesha. You need a 50% rally in the market for you to come back to just 100 rupees, right? Think about it. You've lost effectively 2 or 3 years of your life, of your investing life. For a 50% rally, yaar, kam se kam 2-3 saal to lagega na for you to come back.
Absolutely.
It's like big illness. You are in hospital. So this allocation at least prevent your hospitalization. Okay. Once you get prevented from going to a hospital, you're at home, you're safe. At least then you should hope to make from this allocation, given the rupee's weakness, given the gold looks okay, government security is returning 7%, you should make anything between 3 to 10%. Assuming equities also do that little bit of, weightlifting at their end. I'll be happy with that return in this environment.
Sure. So this is about equities. What about gold? Can gold make up for what equities will not give you?
So they have already made up. Are you wearing gold?
Right now, yes, I am.
See? So you're richer than I am because I'm not wearing nothing.
Go ahead. Who stops you from being Bappida?
So that's the point, right? So you're a smart investor and you've got some gold on you, which is great. I think gold is a good place. I mean, it has had a great run. So I don't think it's like a blowout one right now. But I think over years, I think you're still going to make a decent return on gold, and not for any other reason, just for the rupee being a weaker currency, because the rupee needs to weaken to bring India's economy back. So I think just on that front alone, gold should give you a decent enough return. Again, no prediction, but a decent return. It has had terrific returns last couple of years. I think it's an okay place to be in.
And apt cash levels?
Cash levels, I'm at least we don't hold much cash at most times. So between 5 and 10% is enough. I don't think you need to hold more cash.
Sure. Now let's come to this 40-50% equity allocation that you're talking about. Within the equity pie, how is it that you diversify? I mean, you've seen that the safest is nothing. There is nothing safe right now. I mean, back in 2019, you could still say large cap, blue chips, they're the safest bet. Up to you can't even say that. So where is it that you're safe when it comes to equities? Or where is it that at least you can place your bets with some visibility that I'll be safe?
So the safety part of the market of the 50%, first and foremost, you should have at least 20 to 25 stocks in your portfolio. Again, let me reiterate, most people in equity markets are destined to lose. That's the unfortunate reality. It's only a handful of people who become wealthy in equity markets. And it is those handful who make the headlines, while the rest of the people say, why aren't the headlines about me? Because I've been wiped out for years investing in equity. The reality is it's because of a lot of reasons, but not in the least because there is no discipline that people have. But indiscipline. So they will hear a broker's call, to daily buy sell report aata hai, buy today, sell tomorrow, ye karo, wo karo. There's huge hodgepodge of information. You are not building a portfolio. Build a portfolio. If somebody tells you buy this, ask them, what should I exit? You should have not more than 20, 25 stocks in your portfolio. 5%, 4% per stock. If something falls 25%, you're down maybe 1% on your portfolio. You can live with that. You see, that's the point. First and foremost, diversification across asset classes. Second, even within your equity pie, please be diversified. Don't have overexposure to any. Like we have pharma in our PMS. We have only 25%. We like it. Are we going to have 50%? No way. Not a chance. That's the point. Even if I love it so much, I will never have more than 4-5% in a certain position. So even if it falls 25%, even I have a position for 90%, it doesn't hurt me. Because there are such small parts of my portfolio that, that I'm losing 3-4%. I can live with that. So the 50%, the answer to that is diversify across 25 stocks, at least maybe 20 stocks, and then have a sectoral diversification. So if financials are 40-50% of the Nifty, don't make your 40-50% of the Nifty. Okay, leave those stupidities to professional fund managers. Because we know how people manage. They had so much money in just a handful of stocks. It's ridiculous. You can't manage people's monies with these kinds of very, very cowboy kind of approach to money management. At least diversify. That's the first and foremost thing.
Right. Talking about the subject in pharma, the companies which are currently trying to develop a COVID vaccine, and it's on the screens, there's Serum Institute, Bharat Biotech, Cadila Healthcare, Indian Immunologicals, and Minvax. Out of these, there is only one listed entity. the market is chasing pharma as if every company is going to produce a vaccine of its own. Within pharma also, Shankar, I mean, it's a little difficult. What do you buy? Because, investors such as you may have options and ability to invest in these non-listed stocks. Others don't.
So again, in pharma, we have no clue who's going to make the serum, and maybe that one company might get it, might be an unlisted company getting it. Take a portfolio approach. So buy 7, 8 of them. Simple. Because
With
you will
7,
never
8.
know. I don't think there are 50 pharma companies in India worth it. So again, diversify your basket. If the sector looks good, don't buy just 1 or 2. Have 3, 4% diversified over 4, 5, 7, 8 stocks. So that way, at least you'll catch one of the winners in that sector, whoever that is. We have no clue who that is going to be.
Sure. On specialty chemicals, and Shankar, this has been a darling of yours as well. We know the kind of returns it gave all of 2019 as well and continues to do so. You think rupee depreciation, the crude fall, the fact that global players are now turning away from China could turn out to be India's advantage? Is this the sector to be in? And again, within specialty chemical as well, you can't classify in them in just one basket. Each and every company does its own thing. So how is it that you pick and choose here?
So again, it's a pretty tricky sector. So let me not tell you that it's the easiest thing. Every company's product portfolio is different, and the dynamics on a global basis are different. But the broad China theme has supported the industry, and that happened not just today. That happened, like I think 2014, 15, when the China sort of clamped down started. So it's been a good sector. It has obviously remained a favorite of ours. Within that, again, I don't want to go out and give recommendations. Take a portfolio approach, buy a handful of companies. Some will turn out to be bigger winners than the rest. So. Again, without getting into too much of the micro, that's a reasonable sector to be in.
Okay. Besides that, Shankar, you said that, don't be foolish. Don't go and chase that 40, 45% weightage on the Nifty. What's happening within financials is very interesting because, again, there is a clampdown of sorts. People are relooking at NBFCs. Even the bigger boys are not really getting spared in this market fall. What are you safest with? Is it those large private sector 2, 3 names that you should stick with right now?
No, absolutely, because it's a troubled space without any debate. And if you necessarily have to be in it, I mean, we don't have any, so that's fine. Yeah, so we don't have any of the financials, but that's okay. That's our call. I'm not saying that should be, again, no recommendations. But I'm saying even if you have to have some degree of weightage in that, right now, buy the ones which have got good liability franchises, and we all know who 2, 3 of them are. So remember one more thing, very interesting in banking, that you can be a bank which is bankrupt, but you can still continue doing business as long as you keep getting liabilities. That's called a zombie bank, right? So, you could be you're negative, you could be negative net worth, but as long as people believe that you'll continue in business and they keep putting deposits in and not withdrawing so much, you'll continue as a zombie bank. I'm not saying there are zombie banks that are there, but I'm saying there are, at least go for the ones which can get liabilities financed. Like you don't want to be in names where people are pulling out deposits. That's the unfortunate reality. Some of them I know very well, but it's just a tough environment for second, third tier banks.
Yeah. And I guess the stock market is sort of justified in the way some of these stocks are getting treated. What happens to FMCG, Shankar? Because amidst all that is happening right now, you're touching base with only very few sectors. There's telecom in your life, which is making this webinar possible for us. There's FMCG because you can't live without food. The rest, all of it goes for a tizzy. And yes, maybe healthcare and sanitation.
Yeah, so we don't have much to choose from. That's pretty clear. But you don't need that many stocks to make a living, right? I mean, as I said, you need to have 20, 25 stocks. I think you will find them as long as you diversify it within India, globally. Per position should not be more than 4, 5%. If you follow those rules, by and large, you'll be okay. I'm not saying you're going to become, a billionaire doing that, but at least you will not get wiped out, become a pauper. And who knows, one out of those 2025 is going to become a Bajaj Finance and give you a 100x return, right? But if you go out looking for Bajaj Finance, there's no way anybody can say who's going to go up 100 times. Even Sanjeev Bajaj had no clue that it would become so big. Jeff Bezos had no clue Amazon would become so big. So nobody knows anything. You're just guessing, right? So guess with 20, 25 names instead of guessing with 2 names.
So FMCG should be part of your portfolio?
We don't like a lot of them. They're just frightfully expensive. And again, we are not storifying. We're not in the game of storifying and investing like some other investors do. So, we have Asian Paints and, all those kinds of names. But I mean, we are not like believing that all paint companies, the unorganized sector will get wiped out and Asian Paints is the only guy benefiting. Maybe they do, maybe they don't. But they are extremely expensive. And I would be surprised if they start underperforming also, because they've had a pretty strong run over the last couple of years.
Yeah, sure they have. What about pure play staples though?
What is pure play staples?
No, I mean your likes of Unilever, ITC for the food business.
No, so ITC we don't own. For a variety of reasons. So we don't have a strong view on that, positive and negative. We just don't find space for it in our portfolios. Unilever we own. No very strong table thumping view on it that go out and buy it, great management, great franchise. I mean, again, we don't storify investing. And it's another business. You could be building a house or driving a truck, and we are investing in stocks. I don't get too intellectual about this business. So the fact of the matter is, if we have it, we don't believe it's a greatly cheap stock. But for lack of other things to own, we have a bit of it.
Is telecom an obvious? I mean, if you didn't participate all of 2019 or when your Bhartis of the world were hitting the lows, should you still be jumping in?
So Bharti is, there are only 2 plays more or less, right? Reliance is one and Bharti the other one. Reliance is more pure play. I'm sorry, Bharti is more pure play. Reliance is not. It does appear that, at least the worst of the sector is behind us. And in that sense, it is one of those enablers of a digital world, which we will see more of. And like the webinar, and I don't think we are going to go back into auditoriums anytime soon. And work from home becoming a necessity. Many companies will switch to that. In all of that, the enablers are obviously telecom companies, so we like them. At least we like one of them.
Gaurav Parikh has asked that, do you think one should still stick with the sector leaders or look at potential growth stories that are not necessarily market leaders but have potential? For example, let's say in consumer goods, credit card, microfinance space, and SBI cards, Bajaj Finance, Bandhan Bank. These are examples that he's given.
So I can't give individual stock view.
Sure.
If at all you want to go down that path, please do your homework very, very carefully. But more importantly, it's all about position sizing. So even if you have to go a little further away from the comfort zone, and I have no problem in doing that, you should do that. I mean, it's not that everything should always be safety, safety, safety. You need to be aggressive at some point of the market cycle, but please do not put all your money into those plays. Again, carve out a space for those kinds of aggressive plays. Maybe 10% of your portfolio, maybe 20% of your portfolio, but definitely not 50% of your portfolio. And if they are that good, they will grow into becoming 50% of your portfolio. Let them grow into occupying a large part of your portfolio rather than they're starting out being a large part of the portfolio.
Makes sense. Shankar, in the post-COVID world, I mean, we don't know what's going to really happen, but what do you see humanity do more of? And, from within that, then we can derive sectors that one should look at.
So humanity is either producing many babies or they're getting divorced. That's what
COVIDians, yes.
All the time. So one of the two, definitely happen. Not so. A lot of the webinars will keep happening. I mean, I think, many companies, including, for example, us, we found that life goes on. In many functions, you can have people work from home. I think that's a reality globally. So, video calling apps, enablers of the digital world. I think those are great places to be in. I definitely do not see a return to everybody driving or taking a train to office. I mean, for sure, I think that's like a big behavioral shift that will happen. Because companies will figure out that why do I need this mega complexes? People can work from home. I might even pay them a little bit more. You know, why the ping pong tables and the pool tables and the swimming pools and the cafeterias? You can cut down on a lot of these costs which you need to have just to tell people, hey, it's a great place to work in. So a lot of structural changes will happen. And I'm sure you are hearing the same thing from many companies. I think commercial real estate globally is in a bit of a pickle now.
Yeah. And, on the point that you made on autos as well, company after company is saying that shared mobility is going to be a big no-no because everyone would prefer going solo in their own cars as opposed to taking an Uber or Ola or what have you. But then again, that whole question on if everyone's going to work from home, who's going to be driving out in the streets? So,
exactly.
So do you buy autos or not then?
Exactly. So yes, you're right. People don't want to share a cab. But do I at all want to go out?
Yeah.
Right? So I might have to get all the food inside and, watch a movie at home rather than go to a theater. So behavioral changes are happening. So the car company, look, they're badly hit. We have liked those companies a long time. I think they're clutching at the straws here.
But Tata Motors has done well. I mean, a large part of their capacity is now up and running. They're delivering JLRs back to China.
Yeah, from 170 to 90, if that's doing well, then we'll take that, right?
Well, that is doing well in the current scenario, Shankar. It's doing very well.
Yeah. So you had a vertical fall, then you've seen a vertical rally, and we are all getting happy. The fact is, it was 170 in January, so it's still a long way away from there.
What else is going to be working or not be working when it comes to market sectors?
So I think anybody who's believing that the India growth story is coming back, I think we need to recalibrate because the growth story was not there anywhere for the last 2 years. We have seen that, and it's unfortunate that it just happened now that India wanted actually a pretty strong tailwind of growth, and on right there and then you had this. I think we are going to have a lot of social unrest, strife. It's not a good situation, Ayesha. I mean, and I don't want to sound alarmist, but we have to see it for what it is. And whatever one reads about the urban poor, etc., it's not making me feel good at least. So I think all of us will need to recalibrate our India strategies. We can't expect India to go back to being an 8-9% grower anytime soon, for sure.
Someone wants to know what happens to the entertainment sector at large, the likes of an Inox Leisure, PVR, Delta Corp. I mean, no one in their right minds is going to be heading to a multiplex anytime soon. But when things do become normal, whatever normal is right now, because there'll have to be that sanitization, social distancing, etc., could these sectors revive? Because I recall even after 9/11, everyone was like, no one's going to fly. But I mean, look what happened to the aviation boom after that, even in India.
But 9/11 was completely different. It was a one-time event, and unless you believe that there's going to be terrorist attack every 3 months, I think I don't think you can compare the two at all. This is very different. The only way you're going to see normalcy come back into this is if there is a vaccine. So if there is a vaccine or a proven, in fact, not even a cure, but a vaccine, only then you're going to see normalcy come back to, a mall or a movie theater and stuff like that. Till that happens, only the very, very few and the very brave and maybe the very foolish will be out there going to a movie cinema. So let the vaccine come out and then you can by all means go out and be aggressive buying these stocks.
Just one point to that, Shankar, because I was just chatting with someone about the prospects of OTT platforms going forward. Are movies going to be released on these OTT platforms, etc.? The one thing is that the cost of telecom is going to increase. We're already paying for a Geo broadband, for instance. For a 1 Gbps plan, you'll end up paying almost about 50,000 plus. So, you'll have to recalibrate your spends as well within your spectrum.
Yeah. So we have too few telecom companies. I mean, that is the reality. No other company, no other country of this size has just two companies, or maybe two and a quarter companies providing telecom services. It just become very, very concentrated, and that's not going to be good for consumers. So, even I look at my mobile bills and they're very different from what they used to be.
Yeah, absolutely. So tell me, what's happening with the lockdown? We're missing all your restaurant critiques, updates and all that. Have you been cooking at home?
No, not cooking, and it's been very Spartan life, to be honest with you, just because, access to, a lot of stuff is not that simple, and it's, we are living it through. I mean, I don't know what your take is. Does it lift on May 3rd, or does it get extended, or is it going to be patchy? What are you hearing?
I don't know, Shankar. I mean, we are yet to hear, and hopefully we should. I mean, Sunday is the last day when technically the lockdown was to be lifted. You're already seeing the phased lockdown lifting already happen with various industries, and various companies are opening their setups already. But let's see how it pans out. I mean, I'm sitting in a state like Maharashtra, which is technically red zone. So you really don't know what's going to happen. And even when the lockdown lifts, I mean, how soon can we really return to normalcy? So it's a big question mark. But we should hear from the Prime Minister soon. I'm sure there's going to be an official announcement. It has to.
Yep.
Yeah. Yeah, but what days? I mean, we've lost two legends of the Indian cinema in just the last 2 days. That's just been on my mind. Irfan Khan, Rishi Kapoor.
Don't discuss that. It's so.
Yeah.
I mean, I'm absolutely broken. I'm absolutely shattered. And both Irfan and Rishi Kapoor, two of India's finest actors, and this just been a brutal last 2 days for this.
Yeah, it's one of those melancholic times. It's a
Absolutely.
catharsis of sorts,
And the tragedy for Rishi Kapoor's daughter, that she, can't even, wasn't able to be there. I mean, imagine that.
Yeah.
It's just a weird thing.